Welcome to the Deep Dive, your shortcut to strategic knowledge. Today, we're tearing into the nice Q3 2025 earnings call. And this was really the report the market was waiting for. A big positive surprise that sent the stock flying.
Exactly. Our mission for you today is to cut through all the management talk, the standard presentation, and get to what really matters for an experienced investor. And the core tension here is very clear. They are all in on this multi-year transition to an AI-first, cloud-native platform. And this quarter, they just proved the strategy is working, even if it comes with a cost.
Okay, so let's unpack the results that got everyone so excited. This was a beat on both the top and bottom lines. Not a huge one, but decisive. Non-GAAP EPS came in at $3.18.
Right, just squeaking by the $3.17 consensus.
And total revenue hit $732 million, which was about $3 million ahead of what the street expected.
But the number everyone was watching, cloud revenue, that's the key metric.
What did that come in at?
$563 million. That's a very solid 13% growth year over year.
And the durability, in this kind of macro environment, that's what drove the reaction.
Oh, absolutely. That's why you saw the stock rally over 6% intraday. And the volume was, triple the usual? It shows real conviction.
Right.
But if you connect that to the company's financial foundation, the story gets even better. Nice finish Q3, completely debt-free.
Debt-free.
Gone. They paid off $460 million of outstanding debt. And they still had enough cash to buy back $41 million in shares. That financial cleanup, that strong balance sheet, it gives them the firepower they need for this aggressive AI push.
That's the critical link right there. Balance sheet strength is funding that strategic acceleration. So how fast are those AI investments actually turning into growth? Because management just kept hammering that point home.
It's accelerating faster than I think most people expected. CX AI and Self-Service Annual Recurring Revenue, or ARR, that metric accelerated a stunning 49% year over year.
49%. Wow. And is that all organic growth?
Not all of it. If you strip out the effects of the Cognigy acquisition they just closed, the organic growth is still 43%.
That's still a massive figure. It really validates that whole AI-first message. It sounds like it's not just a marketing story anymore.
It's totally operational. Management was very clear on this. AI capabilities are now, fundamentally baked into every new seven-figure customer experience deal they signed.
So it's not an optional add-on anymore. It's just part of the package.
It's table stakes for their new enterprise customers. And you can see that demand immediately in the cloud backlog, which grew 15%.
And speaking of Cognigy, let's dig into that. The acquisition closed early, back in September. Management is really framing this as a huge piece of their future.
They are. Because it closed early, Cognigy added about 50 basis points, so 0.5% to Q3 cloud revenue growth, and they expected to add 150 basis points in Q4.
So a much bigger contribution coming.
A much bigger one. But the long-term target is the real prize. $85 million in exit ARR from Cognigy by the end of 2026. What's smart about this acquisition is that they're positioning Cognigy to grow across the entire CX market.
Meaning they'll sell it even to customers who don't use their main platform.
Exactly.
Right.
They can sell it as a standalone product or bundled with their core CIS platform. So it expands their total market while also pulling more people into their ecosystem.
That dual sales motion, that's a powerful strategy.
Yep.
It's also fueling their international growth, right? Which seemed to have some real momentum.
It does. International revenue was up 11%, and that was driven mostly by APAC, which grew 19%, and management tied that growth directly to their investments in sovereign cloud infrastructure in those regions.
Okay, but those investments, they don't come for free. This brings us to the other side of the coin. The part investors are probably more skeptical about: margin compression.
Right. This is the strategic tension. Aggressive investment comes at a cost, and we're seeing that cost now.
We absolutely are. Non-GAAP gross margin compressed by 120 basis points, so 1.2%, landing at 69.9. Operating margin also took a hit, down 50 basis points.
And management was very direct about this. They said it was due to heavy spending on cloud infrastructure, that international expansion, and, all the upfront costs of scaling their AI footprint.
At the same time, you still have the headwind from customers moving off the old on-premise systems.
Yeah, that migration continues. Services revenue was down over 7%, and product revenue fell off a cliff, down 24%. But the most important data point, the real signal from management about their priorities, was the guidance.
Okay, what did they guide for?
So they actually raised their full-year revenue guidance slightly, but, and this is the the updated full-year non-GAAP EPS guidance. That range of 12.18 to 12.32 now sits below the street consensus of around 12.43.
That is the clearest signal you could possibly ask for. They are deliberately choosing to miss near-term earnings consensus to invest for the long term.
Exactly. They are absorbing the Cognigy dilution and all those infrastructure costs because they believe winning the AI race now is worth more than a small EPS beat today.
Which makes sense, but you have to wonder how the market digests that, especially given where the stock has been.
Well, let's put it in context. Despite this big two-day rally, the stock had been a massive laggard over the last year, down almost 27%.
Well, the broader software ETF, the IGV, was up
over 4%. So that underperformance provides the context for this bullish reaction. Investors are finally rewarding the visible AI growth and the clean balance sheet, and they're willing to look past the margin pressure, at least for now.
Okay, what about competition? They must have gotten questions about all the new AI startups, the agentic AI solutions we keep hearing about.
They did, and their response was, let's just say, very confident, almost dismissive. They basically said these new entrants aren't a threat, they're just validation that the market for CX AI is exploding.
I have to wonder, though, isn't the moat around proprietary data eroding faster than ever? Are they just talking their book?
They believe their differentiator is enterprise scale. The argument is that they combine their core platform with this purpose-built, domain-rich AI that a general LLM just can't match on its own, especially with all the enterprise guardrails you need. They're betting that context is king.
We should get more clarity on that pretty soon. They kept pointing to their upcoming Capital Markets Day.
November 17th, that event is going to be crucial. That's where they've promised to give a detailed 2026 and midterm outlook. We should get targets for margin stabilization and a real timeline for those Cognigy synergies.
All right, before we wrap this up, let's move to our segment that is purely for entertainment and strategic thinking. This is, of course, this is not financial advice, trade ideas segment.
Yes, and let me be crystal clear. We are not advising you to buy, sell, or hold anything. This is just an outrageous but plausible trade idea based on what we've discussed, pitched as if we were, extremely bullish.
Okay, lay it out for us.
The thesis is simple. The market punished NICE for a full year because of short-term margin pressure, creating that massive 27% underperformance. But now the fundamentals are accelerating. The balance sheet is debt-free. AI ARR growth is at 49%, and they've made a key strategic investment in Cognigy. The true inflection point will be that Capital Markets Day. If they give positive 2026 guidance, confirming margins are stabilizing, and the Cognigy ramp is on track, this stock is positioned for a major re-rating.
So what's the trade?
The trade idea is a bull call spread. It's a highly confident leveraged bet, but with defined risk. You'd essentially be structuring a position that says you believe the stock will move significantly higher over the next 12 to 18 months, reclaiming all of that lost ground and then some. It's an aggressive way to participate in the upside you expect from the AI strategy finally being recognized by the market.
That's a fascinating way to play it. Okay, so to summarize our deep dive for you, NICE delivered a top-line beat, cleaned its balance sheet to zero debt, and proved its AI-first strategy is working with that 49% ARR growth. But, and it's a big but, they're deliberately taking a hit on near-term margins and EPS guidance to invest in that future.
And that leaves us with our final provocative thought for you to think about. Given that the stock is now priced below the street's consensus for full year 2025 earnings, how much margin compression is the market really willing to tolerate for the possibility of hitting that $85 million Cognigy target and pushing cloud growth even higher in 2026?
That tension right there between today's margins and tomorrow's AI dominance is the entire story to watch. Thank you for joining us for this deep dive. Please remember to do your own research. We'll talk to you next time.